This is Andrew Stotz of Stotz Investment Research looking at our value model. In this case, I'm looking at the company AKR, Corporindo in Indonesia. So today's topics, I'm going to talk about the background of the company, the forecasts, absolute and relative valuation, and sensitivity. But before we do that, let's look at our disclaimer. And this example was created on the 22nd of February. What follows is not a valuation, forecast, rating, or recommendation. It's a teaching example. What follows is not investment advice. It's a teaching example. It is intended only as academic information for those who want to learn more about valuation. It should not be construed as the basis for any investment valuation. And the information in this presentation came from various sources, which we believe are reliable, though we do not guarantee the accuracy, adequacy, or completeness of such information. Lastly, I hope you enjoy learning about valuation as much as I do. So let's get into the background. AKR was born as a small chemical trading business over 55 years ago in Surabaya, and it has grown to become one of Indonesia's largest private sector distributors of basic chemicals, petroleum, logistics, and supply chain solutions. AKR is supplying refined petroleum products from international refineries to the mining industry, government power utility, industrial and commercial establishments, and also to the retail sector through its petrol stations. Today, AKR is the supplier of choice to industrial companies in textiles, alumina, chemical industry, soap and detergent industries, construction and consumer-related industries, and supplying basic chemicals. The 9-month 2016 revenue breakdown shows that 68% comes from petroleum distribution. Let's talk about the forecast. Now, the first thing about the forecast that, that we can see about this company is that the revenue has been falling as oil prices have been falling, but impressively, the net profit has been rising, which is very impressive in a falling environment. The net margin, therefore, has risen to about 8.4, and I'm going to keep it generally flat and up slightly for that period. The next thing is the balance sheet of the company, the asset side of the balance sheet. We can see that the total net fixed asset growth is about 7%. And total asset growth is about ranging between 7 and 11%. The amount of funding that the company gets is short-term, very small, and long-term debt, they have a reasonable amount at about 3,203 as of 2016. The dividend payout ratio is rising slightly, and I'm forecasting it will rise in the future. So if we now look at the cash flow statement, what we can see is operating cash flows are positive and rising over time. And we can see that the investing cash flows related to both CapEx and investments are staying pretty stable over time. So now let's look at the absolute valuation of the company. And when we do that, the first thing we want to look at is the free cash flow data. And in this example, what I like to look at is the NOPAT, and also looking at the amount of CapEx that the company's got and the change in working capital, which is right there. From this, we want to look at the amount of invested capital in the business, and we can see 10776 is the current amount of invested capital. And we assume that that's going to rise slightly. So the return on invested capital is almost doubled, and then we're saying it's going to stay that way until we get to the fade period where it will start to come down. All right, so now let's look at that and see the earnings per share growth is about 10 to 20%, but the dividend growth is actually 36% in 2017 because of the increase in the payout ratio, and 24% in 2018 also because of another increase in payout ratio. So let's look at our assumptions. Remember that Indonesia is a high interest rate country. Therefore, the risk-free rate is about 9%. That incorporates the very high interest rate. So the market premium, I'm estimating at 9%, which gives me a market return of 18%, a pretty high market return in Asia, but mainly driven by the fact that there's high interest rates for a long time in that economy. Now, the company's beta, I'm saying, is 0.75, which gives a cost of equity of about 16%, let's say 15.8. And if we look at the cost of weighted average cost of capital, we come up with about 13.5. So 13.5 to 15.8 is the range. Now, here we've taken a 3-year linear fade where the company can move down to normal profitability. And we're fading that ROIC down to the weighted average cost of capital. Growth assumption for terminal period is 3%. And also the multiples we can see for the terminal period, 9.5 and 7.8, relatively reasonable, right? So we can map that out and show that the discrete period we're showing a rising and rising NOPAT, but eventually in the fade period, that growth slows down to be 3, 2, and 0 at the final fade period, and then we move to the terminal period. So now let's look at what we find about absolute valuation. First of all, the difference in value between free cash flow to equity and free cash flow to the firm comes from a higher value for the discrete period and the terminal period, while the fade period has the same value. So what we can see is that dividend discount model values the terminal period at 4 versus free cash flows value it at about 7 to 7.9. Now, of course, in the case of free cash flow to the firm, we take away debt, and we end up there with free cash flow to the firm of 10489 as shareholder value. And so the equity per share comes out to be 2655. So with a current price of 6125, AKR appears to be expensive based on DDM, free cash flow to the firm, and free cash flow to equity. Now, let's look at the relative valuation. And PE is what you pay in price for one in earnings, and it is a simple and commonly used measure. We compare a company against its sector in its country, its region, and worldwide. The company's 2017 EPS times the country's PE in 2017 for the industrial sector gives a value of 6787. Now, the absolute values we've already said are 2297, 2655, and 4168, and now we've got this 6787. If we look at the chart, we can see from a PE to growth basis, the stock looks a little bit cheap compared to Indonesia. And if we move on to the price to book, what we're going to see is that the price to book is especially useful for firms where assets are the core drivers for earnings, which is here, or where earnings are volatile. The price to book multiple of Indonesia's industrial sector for 2017 times the company's 2017 book value per share results in a value of 4754, lower than the PE value. Now, of course, here's an interesting thing where we can see the ROE of the company is 21 versus the ROE of the industry. So by multiplying times 2.5, which is the industry, we're not really compensating for the fact that the company has a higher return on equity. So in fact, if we did that, we may find out that the price to book value comes up to be higher than 4754. So the current price is 6125. The relative value estimates show the share may be fairly or overvalued. Absolute valuations show that the stock may be overvalued also. So now let's move into sensitivity. And again, I look at sales, gross margin, discount change, and terminal growth. And from this, what we can see is that the net margin of the company and the EPS is pretty volatile when it comes to gross margin. And that we can also see that the value, in particular, you can see the PEG ratio is almost always super volatile. But from a free cash flow to equity or a dividend discount model, we can see the variation that is coming between the bottom and the top here. And we can also look at terminal growth assumptions and discount rate assumptions. Now, in this case, our discount rate was pretty high, right? So maybe what we say is, oh, we'll bring it down. And here we bring it down to 15. And we can see that the value of the company rises slightly. So that gives you an idea of AKR. I hope you learned something from it. Have a great day.